Did you know that of all the accounts to save in, the HSA can be the most tax-advantaged way to save? Yes, more so than an IRA and a 401k. That's right, the super stealthy, definitely misunderstood, and widely underused health savings account should be your go-to bucket for savings because it has potentially quadruple tax advantages. You heard that right, 4. Curious what they are? Don't worry, I'll tell you. But let's start with the basics. Many people closely link the HSA to its older stepsister, the FSA, but in reality, they are very different. First and foremost, an HSA is not use it or lose it like the FSA. You can and should be accumulating a balance in your HSA. Now let's talk about the tax advantages. Number 1, money that you put into the HSA is generally tax deductible in the year you make the contribution. Number 2, any money invested in the account grows tax deferred. Number 3, if you use the account for qualified medical expenses, then all of the money can come out tax-free, not just your contribution, but also the earnings. Bonus tax advantage number 4, your contribution also isn't subject to FICA taxes. Your 401k contribution is. FICA taxes alone are 7.65%. If you are self-employed and your plan is set up correctly, you could be saving 15.3%. Now let's compare that to the 401k, whether it be Roth or traditional. A 401k only gets 2 of the 4 tax breaks, and HSA can get all 4. But wait, there's more. Here's a little secret that most people don't know. Yes, there is a requirement that HSAs be used for qualified medical expenses. And if you don't use them for those, then you may have to pay a 20% penalty. However, that requirement goes away when you turn 65. Once you turn age 65, you can continue to take tax-free distributions to pay for these qualified medical expenses. In the event you just have way too much saved and need it for other things, you can still access the account without penalty, but you do have to pay tax on the distribution, which essentially means by the age 65, your HSA is a supercharged traditional 401k with tax-free distributions for medical expenses. Fun fact, you do not have to use it every year for medical expenses. You can accumulate those receipts over time and submit them later, like years later, for reimbursement. Here's what you need to know. If you have a high deductible health plan, you are likely eligible for an HSA. I normally recommend you contribute enough to your 401k to get your full match, then max out your HSA, then go back and finish maxing out your 401k. Most people are at least contributing to their HSA, but many of you are not investing it. Look, the account really shines when you invest it for growth and don't touch it. Keep enough in cash to cover your annual deductible or anticipated medical expenses just in case you need it, and invest the rest. Treat it like an emergency savings account. Only get into it if you have some major expense you just can't cover. Otherwise, don't use your HSA to pay for those piddly prescriptions and $20 copays. Cash flow those and let your HSA grow in all its potential tax-free glory. That's it for this week. This is Jeannie, the 401k lady.